Joining us right now to help answer that question, Jim Paulsen, Chief Investment Strategist at Wells Capital Management, which oversees about $375 billion in assets. Jim, great to have you back on Street Smart. So do the gains continue in your view?
I think so, Carol. I mean, there's certainly, I agree that there's high odds that sometime during this year we get a bit of a correction. But when that will be exactly, I think it's very difficult to tell, whether it's early in the year or late in the year, from higher levels. I think the best thing for investors to do is focus on the fact that we are early in this economic recovery, and we're probably still early as a result in this stock market recovery. If we do have a correction, the mid-recovery corrections that we had, for example, in 1984 or 1994, tended to be of short duration and of mild magnitude, and I think that's the best way to look at it.
And you think the financials support that upbeat outlook? Of course, we got Citigroup today losing $7.6 billion on cost to repay those bailout funds, but nonetheless, we are hearing from the financials, big focal point. What we're getting from the financials, Jim, on the earnings front, that supports an upbeat outlook for you?
Well, I think so far what we've gotten has been a little bit disappointing. But I think it hasn't been disastrous by any means, Carol, and we probably have some better ones coming up as well. You know, I think it's encouraging day and city that their write-offs have come down a little bit. I think the charge-off rate in banking is probably peaking in this quarter and starting to come down. You know, I just look at the financials. They got a marvelous operating environment here if you back away from it, with essentially a very steep lending curve and essentially free deposits. If you take that operating environment and now you give them some loan volume, which I think will come about with the revival of business lending as they rebuild their inventories, they need financing for that, and consumer lending, because I think we're going to create jobs in this first quarter, and that'll bring some consumer borrowing back as well. Lending volumes on top of this operating environment, I think there's good profit leverage here in the large cap financials.
Jim, I want to stay with the financials for a moment, because we do hear from Morgan Stanley on the earnings front tomorrow, then Goldman Sachs the day after. I mean, what do you think are the biggest challenges for these financial firms like Morgan and Goldman? I mean, and what do you think they have the most going in their favor?
Well, I think the biggest challenge is going to continue to be just two things. One is lack of top-line loan volumes, which I think we kind of know is there, because right now businesses don't need financing because they've been pairing inventories, and people don't have job creation yet, so they're not borrowing money. And then the second one is they still have the aftermath of write-offs, which has more to do with what we've been through than telling us where we might be headed. You know, write-offs they could occur the rest of this year, even though the economy continues to recover. Those are the two downsides. The good news there, Carol, I think, is that that's fairly well expected. And I really believe that the going forward, the best news is just the extraordinarily positive operating environment, wide lending spreads, essentially free deposit balances. That you just can't underestimate the power of that if you give them a little loan volume back in the second half of this year.
Jim, what happens though when the Fed starts to raise rates? They will eventually raise rates here. I mean, then that operating environment certainly changes dramatically for them.
I hope like heck the Fed has to raise rates, and the sooner the better, Carol, because what that tells me is the economy is healthy enough for them to raise rates again. And this is something that in the middle of the crisis we all would have rooted for, that we would get an economy healthy enough to have to lift interest rates. So my point about that is, yes, the yield curve would start to diminish, the cost of deposit balances would go up, but the only time the Fed could do that is if there is indeed more lending volumes that allow them to do that. And I think that'd be a good event for the banks.
Jim, got 30 seconds. Let me circle back to something we started off with our Mike McKee about the new normal. Wall Street doesn't buy it, but you got PIMCO saying it's going to be a very different growth environment longer term. You don't buy it either, or do you?
I don't so much. I think what the PIMCO is most focused in on is the consumer is way over indebted and undersaved, and they're going to have to reduce their rate of spending for a period of time to repair their balance sheets. I don't disagree with that even, but what I think they're missing is there's other parts that could step up if the consumer delivers a little less. One of them is net exports is now a positive contributor to growth rather than a negative. And the other one is we just had a decade where businesses sort of repaired their balance sheets, and they now could step up and spend more money. I think the net result is a different composition of growth, Carol, but perhaps about the same growth rate.
Well, time will certainly tell. Hey, Jim, thanks. Good to have you back with us. Jim Paulsen over at Wells Capital Management.